Hi, everybody. A very good afternoon to you all. So, the 5th of this month, like every month, we released a November edition of Netra. This one, too, has been an attempt to put together insights across different markets, segments, and drivers of returns. Before we start this presentation, I will give you a glimpse of what Sahil will talk about for the next half hour. So, we talk about starting with a 3 year long historical perspective of the monetary and fiscal policy, especially across the US and the UK. The next is why and how a balance of payment stands to be more crucial than the balance of trade, and which is that one particular variable which contributes to the significance. Next is the deleveraging of the private and the public sector and what it means, especially in an environment of a boost in the household debt. Next is how stealthily there has been a slowdown in the demand indicators. And finally, we talk about the IPO craze. We have talked about it on our previous editions also, but this time we come with this topic with a different insight and a different data set, and why this easy money environment cannot sustain for long. Now, Sahil will take you through the presentation. Also, as a side note, there is a question answer tab on your screens. And towards the end of the presentation, we'll take the questions from you guys. Thank you so much. Over to you, Sahil.
Thank you, and thank you all of you for joining in. And we will straight away jump into our, insight section. As you know that we write this report on 5th of every month, and we release it on 5th of every month. And this time, as Pragati said, there are a number of insights that we want to, chat about today. So we'll start with, our first section, which is on, how stimulus has changed over the last 300 years and where we stand in the cycle currently. And we can, take a number of insights from how things have shaped up over the last 300 years. So this first chart on this report, which is November edition of DSP Netra, you will see that it talks about easy money, right? And what does easy money mean? When monetary conditions are eased, usually central banks and governments print a lot of money or make a lot of money available in the financial system. And the chart that we put out here, if you see the upper panel, there are two charts here. The upper panel talks about the asset size of Bank of England and Federal Reserve. Federal Reserve started in 1933, so to say. But Bank of England has data going back from 1700. In fact, they have data going back from 1200 and so. So it gives a good color of how things have changed over a long period of time. As you can see, currently, after the global financial crisis in 2007, the global stimulus or the central bank stimulus, specifically from Bank of England and Federal Reserve, it has reached proportions that we have never seen. Earlier, central banks during the time of crisis, for example, you see the World War II, or you see this bump during the World War One, or during the prior, great wars, etc. You will see that central banks created a huge amount of liquidity surplus by buying bonds of government, right? Financing their governments and thereby inflating their own balance sheets. And this is sort of, in colloquial language now called money printing, so to speak, which means that they are making more money available for governments to spend. And you can see that the size currently that we are seeing is completely out of whack from history. As you can see that at most earlier central bank assets went to 20% or 20% plus of GDP. This time it went to about 32% or more, right? And this is an unprecedented number, even after the interest rate hikes that we've seen in the last 1.5 years and the quantitative tightening by central banks. You can see that this number has barely fallen. Even after, a reversal in monetary policy, monetary conditions are so easy that we haven't seen these kind of conditions in a very, very long time, right? So this is from central banks. And what the governments are doing, if you look at the lower panel, this is the fiscal deficit. What is fiscal deficit? Fiscal deficit is nothing but income minus expenditure of the government. If the government earns less money and spends more, it has to borrow the rest of the money, right? very simple, just like a household. If you spend more money than you make, you have to borrow that money. And this is in, in terms of the country finances, it is called the fiscal deficit or government finances. And you can see that fiscal deficit, when it becomes negative, that means the governments are borrowing a lot of money. Uh, more negative the number, that means the borrowing is increasing, the deficit is increasing. As you can see that there were very, very large fiscal deficit during World War II, during World War One, right? You can see these numbers going up significantly. And when you compare this number to now, we are not in any sort of world war, right? Maybe we are, I don't know. It's not very clear, but it's very clear that many economies are not in a war-like recession currently. In fact, most economies are doing okay. There is some global slowdown, but there is not a widespread recession as we speak today. And therefore, running these kind of war-like deficit is completely out of whack. So not only monetary policy is very, very easy, even fiscal policy is extremely easy. So what does it do? It creates ideal conditions for overpricing of assets. What does it mean? That when credit or money becomes cheaper, then it goes into areas which are more speculative in nature. It tends to increase the value of the same earnings. What I've written here is that when you have very easy money, uh, companies which actually have very high ROEs and return ratios, their valuations go out of whack. So high quality stocks become even more expensive. Even low quality stocks become expensive, and even it is true for other assets also, right? So it sort of acts like a speculative froth on all asset classes, and this is what we are seeing currently. And the only thought that we should remember is that just like we've seen this happen once in 300 years, even the opposite can happen, right? We can see a period like this where, central banks take a call that they don't want to create this kind of a stimulus, just like they took a call that they want to increase the stimulus. And you could have a time when even the governments feel that they want to reduce their deficits. These are all policy decisions. Once these decisions are taken, this easy money environment can quickly reverse. So, over the last few editions of DSP Netra, we have made some of these points, but not in such a great detail. And I think the single largest risk, or we say that DSP Netra is a early warning signal. I think this is one of the single largest risk to, let's say, 5 or 10 year decadal investing sort of signal that you want to look at. If these stimulus numbers change, because they are already at numbers that we have never seen at levels, if they go lower, or central banks decides to act strongly by reducing their balance sheet size, they've been doing it, but if they start doing it more ferociously, if you note that even after cutting interest rates, the Federal Reserve has not actually reversed its stance on quantitative tightening. It is still tightening, although at a very slow pace. It is not doing QE, it is still doing QT, right? And but the governments are still borrowing a lot of money. The moment these two taps become tighter, or they close, or they reverse, it will act like a very large headwind for a large number of assets. And in a very peculiar manner, over the last 1.5, 2 years, what we've seen is that most assets have done well. So if you pick up a multi-asset allocation strategy and if you split it up, you will see that domestic stocks have done well, global stocks have done well, precious metals have done well, bonds have done well. And these are very rare occasions that if you see all assets doing extremely well. And the let's say the tipping point or the pivot can occur if this policy changes, because it changes the background. The background noise changes dramatically, and this is something that we need to watch. Now, how do we watch this? What is the way to understand that things have changed? For example, now the new US administration will take hold, because US is the reserve currency of the world. Let's assume that there is a new Treasury Secretary who says that I don't want to borrow so much money, right? And I want to reduce my debt. This policy will change overnight. So therefore, that policy making will have to be watched very carefully. Uh, and what are the signals coming from fiscal and monetary policy will be extremely important. As of today, there are no signals. We haven't seen any major developments happening, but this is a very important background check that we need to do. Uh, s- uh, Second is corporate earnings, and corporate earnings, as I've shown here, a long-term chart from about 1948. So if you look at these charts, these two lines in the chart, the blue line talks about US corporate profit before tax as a percentage of GDP, right? So you can see that currently it is at about 14.1%. Just about 1.5 years ago, it was 14.8%. You can see that 14% plus readings are very rare, right? Now, corporate profitability in US is extremely high, and similar is the case in India also. In India, the PBT currently is at 10%, which is one of the highest that we've ever seen. So, what does this corporate profitability mean? I have used a phrase here: corporate profits have reached what appears to be a permanently high plateau. Some of you might know that this is sort of a sarcasm from 1929, where Irving Fisher, which was a noted economist, made this comment about corporate or stock prices in 1929, just before the crash of the Great Depression. He said that stock prices have reached what appears to be a permanently high plateau. And this is the case with corporate profits also, right? In US specifically. And what are the drivers of this high corporate profitability? Very large dose of fiscal and monetary stimulus, which has created a big turnaround in the economy. Corporate deleveraging, cost controls, and margin expansion. And third is surge in export earnings of big tech companies. These are the three key drivers in US of profitability. Now we don't know what will reverse or which will reverse, but one thing is very clear that corporate profitability in US is very high, right? And when we talk about fiscal deficit, in the last slide I told you that fiscal deficit is very high. All of you know that US is now running $35 trillion in debt. There are indications and discussions around why and how this debt is so high and what can be done. So, first thing that can be done from a policy standpoint is to raise corporate taxes. Now, this is entirely opposite to what the current narrative is. The current narrative is that the new administration in US is going to cut corporate taxes. But when you look at this data, it is very clear that US corporations do not need a tax cut. Their corporate profitability is so high, any logical policymaker will actually raise corporate taxes, not cut them. So, in order to fix their fiscal deficit problem, one way is to raise corporate taxes, not cut them. So, I think that it is entirely possible, and some of the large investors and commentators have already pointed out that this could be one of the ways to fix the Fisc, not only in US, even in Eurozone or in UK. It's quite possible. And therefore, I think this corporate profitability of 14.1% PBT to GDP is an excessively high number, driven by these three factors, which all the three factors are already at extreme. I showed you the number one factor, which is at a 300-year extreme. The number two factor is also at an extreme, where corporate deleveraging is at a 50-year high, which means corporate debt in US has been running down significantly, and they have repaid their debt by a very wide margin, enhancing their balance sheets. Right? I don't think it will continue at that pace which it has in the short term. And third is surge in export earnings of big technology companies in US, and their profit growths have risen at an exceptional pace. Now it is sort of plateauing, slowing down. So all the three drivers could turn, and again, this could be a very important driver of how US stocks perform. So, what is the conclusion from first two slides? Number one conclusion, that we are in an environment where monetary and fiscal stimulus are very high. Even after the reversals that we've seen in the last 1 year, they continue to be at exceptionally high levels, and they are reversing. Fiscal has not reversed. I think it's a matter of time. Maybe the new administration in US changes that, or it changes if there are cracks which appear in the US Treasury market. It can appear. And second is that US corporate profitability is at such a high level that most likely it will mean revert, right? We haven't seen this type of corporate profitability sustain. Usually it reverses either because corporates start making lower profits or by getting taxed heavily. And I think either of them is possible. I don't know which. So we can take a call and maybe, let the future unfold. But one thing is clear that if corporate profitability is going to get compromised or become slower than what it is today, it will also cause a drag on US equity returns, which means that the returns of the last 10 years or 15 years in US may not happen in the next 5 or 10 years because you are at such an extremity. So this is the conclusion that last 5 or 10 years returns in US particularly, they do appear completely out of whack, and you could see a mean reversion to slightly lower levels from equity markets. The second section will talk about various Indian aspects, India's balance of payment, what are the drivers of growth, and what are the opportunities. So first, in Indian markets, in Indian secondary markets, if you add the primary market inflow, about 1 lakh crores of outflow has happened. And incidentally, just a few months ago, just a few quarters ago, the narrative was that India should get about 1 lakh crores in FI inflows, right? And the reason given was that India is the fastest growing economy, our earnings growth is the strongest, and corporate profitability is high, macroeconomic stability is also very, very high. And all these reasons were very, very genuine and they were all valid. But what we saw was the opposite, which means that we saw not FI inflows, but we saw FI outflows, which again goes and proves to you that forecasting these numbers are impossible and it's a exercise in futility. So we'll talk about what does FI flow actually mean. So first level analysis narrative, when you read about it online, is that high FI flow is equal to high equity markets and FI outflow is equal to low equity markets or lower returns. And I think this is a very spurious relationship and maybe possibly only the first level thinking. So we put out a table showing you where does foreign flows fit into the overall picture. And we feel that foreign flows are a bigger driver of macroeconomic stability than of stock market returns, right? So if you look at this table on your screen, it shows you what is called balance of payment, and these are only select components. It is not the full table. And the balance of payment usually contains three accounts. One is called the current account, where you read about what is called current account deficit. The other two are capital and financial accounts. Okay, they total up and become balance of payment. Balance of payment is always balance. It is always zero. Inflow is equal to outflow. So if there is an inflow happening, there has to be an outflow and vice versa. That is why it is called balance. But current account is not balanced. India current account is in a deficit. You can see these negative numbers. And how does this deficit come about? So we do a lot of import and export, which is of goods, which is merchandise exports and imports. You can see in this category, we run a deficit of about $240 billion. That is what we ran in FY24. We also run a surplus in services. In services exports, so our exports minus imports in services is positive. So you can see that when you look at our current account, the merchandise deficit is slightly offset by our services exports. So we run a very small deficit on the current account as of today, as of FY24. But this deficit zooms up. It goes up significantly if, let's say, oil prices rally. Because as you can see in bad years, for example, look at a year like FY13, right, where our merchandise deficit was around $196 billion, but oil trade deficit was half of it, right? A very large contributor, right? So if oil prices go up, you will see that our merchandise deficit goes up and our services are not able to cover it. So we run in some sort of a trouble. Currently, that number for India in terms of when you think about the oil price is somewhere close to $120. If oil goes above that price, stays there for 6 months, it causes a lot of troubles for India. Currently, we are far away from that number, but oil price, as you know, is very unpredictable. But the moot question or moot point that we are discussing is foreign flows. How do they come into picture? So every time we run a deficit on current account, you can see this number of -23, -67, -56. It is covered by our financial and capital account. And how does it get covered? By FDI and FI flows. You can see these numbers. So we get a bunch of FDI. FDI is very sticky. Once it comes, it stays. But FI is not so sticky. FI is equity plus debt both. Once this money comes in, it can go out also. So imagine a year where you have a very large deficit and FIs also become net sellers. That is the year when rupee depreciates significantly because our financial and capital account is not able to cover our deficit on the current account. But in most years it can. When it is not possible, where FIs become net sellers, what we do is that we borrow a lot of money. So Indian corporates or largely PSUs will borrow money and they will try to balance out what is being lost in the current account, but it is not always possible. Therefore, Indian macroeconomic stability is affected by two things. One, if oil prices go up significantly, our macroeconomic stability is compromised, but the stability will return if even if let's say oil goes to 120 and you get huge amount of FI flows, your stability will be maintained. But there is another scenario. Oil prices shoot up, we are unable to attract FI flows, or we get FI outflows, then we get into a problem. And this is the exact problem we got into in FY 13, FY 14, where we had to introduce what is called FCNR deposit, asked NRIs to put money in India. And that is how we saved our balance of payment. But in under certain scenarios, for example, one scenario I painted where oil prices go up, FI's outflow also happen. That is a scenario where uh, macroeconomic stability is compromised. As we stand today, Indian macroeconomic stability is one of the strongest we've seen in over 10, 20, 30 years. And one of the reasons is India's services and remittances have become very, very strong, right? We get a lot of money from NRIs, almost $100 billion. Often there is a economic joke that what is the biggest export item of out of India? It is actually people. You know, NRIs going out, sending money in is one of the largest export items that we've created. And so that helps our economic stability by a very wide margin. But if I paint a scenario of, let's say, high oil prices beyond $120, FI selling, it creates a scenario where our macroeconomic stability is compromised. Therefore, the biggest role of FI flows or FDI or foreign inflows is actually macroeconomic stability. And this stability is what allows equity markets to do well, right? If this macroeconomic stability is maintained, our financial stability is maintained, RBI does not have to do any firefighting. That allows better business conditions to prevail. And that is how foreign inflows come and impact our equity markets. These daily inflow and outflow, which are published on stock exchanges, have got very little relevance because daily inflows and outflows are matched, which means that if there is a figure of, let's say, 1,000 crores sell by FI, there will be a buy figure from either DII or from clients for the simple reason that in the secondary market, there are no sellers which can act independently without a buyer, which means that if you sell 100 rupees worth of stocks, there has to be a buyer for 100 rupees worth of stocks. So all the figures that we see, all the statements that we see which say that FI sold 1 lakh crores, but markets did well because DI bought 1 lakh crores. Uh, these statements are not logical. And the reason is because when FIs sell, there will be a buyer. So these numbers will always balance out. And the second line of question is, what if DI did not buy? Let's assume that could be a question. If no buyer was present, let's say FI wanted to sell 100 rupees worth of stocks and the buyer were only for 80 rupees, then only 80 rupees worth of transaction will happen, right? And it can cause a price damage, which means that FIs can become aggressive in selling and sell that number. But that is an entirely different matter. The key point is that every sell figure will have a buy figure, and secondary markets are a zero-sum game. So foreign flows are more critical to create a better macroeconomic stability. Currently, their role looks slightly diminished. The reason is that oil prices have been very stable. We've been getting a lot of remittances, but these conditions do not always prevail. They can quickly change either by rising oil prices or reduction in remittances or reduction in pace of remittances or reduction in our exports. Any of these numbers can change, and they change quite dramatically when things go haywire. And therefore, as I said earlier, you need to watch flows from a more broader perspective rather than looking at from daily buy and sell figures. The next is more about domestic economy, and we will talk about a few slides on growth. We wrote about this concept of when you think about the economy, there are three important players in the economy. Okay. One is households, which are usually citizens like you and me. The second is the government of India or the state government put together, which is the government sector or the public sector. Third is the private corporates, right? These are the only three entities operating in the economy, right? Everything else everything will fall in these three buckets. So when you look at these three entities, they are the what I call agent for growth, right? So currently, what is happening is that two agents of growth, which is Government of India and the private sector, both are deleveraging. They are actually reducing their borrowings or reducing their debt by repaying more than what they are borrowing, right? And what does this mean? They are trying to improve their balance sheet from what it was, let's say, 2 years, 3 years ago. What it does is it's a very simple equation. Think about it that um, in your own personal finance, if you start deleveraging or repaying debt, what does it tell you? It tells you that you are trying to maybe in that period of time, trying to be more thrift, trying to be, trying to spend less money and trying to repay debt, right? And this is what exactly these two entities are doing today. What does it do to growth? It slows down growth. The only component which is leveraging is household, right? Household leverage is going up. A lot of people are borrowing a lot more money. But I will show you a chart on the next screen that even household leverage is now peaking out. They have also started to reduce their incremental borrowing numbers. What does it mean? That overall leverage from the system is reducing. It's a good thing, but in the short term, what does it do? It reduces growth. It reduces the ability of the economic growth to march forward or rise at a faster rate. And this deleveraging usually coincides with a slowdown in growth. And when you look at the high frequency indicators, you will see that most indicators are now indicating a slowdown. And we've been talking about this, at least I think for the last 2 quarters, that there were some signs that a growth slowdown is possibly coming up, and we are now able to see a number of these signs, show up in data. As you can see, rural wage growth, when you look at the number at about 5%, if you put inflation, you will see real rural wage growth is actually 0%. BSC 500 wage bill growth, which is, let's say, the increase in salaries and bonuses of corporate employees. It was rising at 15-20%. Now it is rising at 6 to 8%, maybe even lower as we speak about September quarter. Personal loans, which was a source of big strength, there was a big uptick. You can see 25-26% growth was happening. It is now in low double-digit numbers. Still strong, but it is off from the highs that we saw earlier. GST collections, which were growing at 10% plus, are now getting slower. I think the latest number is now getting closer to 6.5, 7%. Petroleum products consumption, again, a very important indicator of demand. That is also now growing in low single digits. Earlier, it was in high single digits to double-digit growth. Machinery good imports, again, a very strong indicator of how capex will happen or is happening. You can see is sliding down towards mid single digit to low single digit. So all these numbers tell you that the deleveraging that I showed you in the last slide is showing up in numbers also. It is showing up in slowing down of overall economic growth. What does this slowdown mean? Earlier we were growing at 8%. Now we are sliding back to maybe 6%, 6.5% kind of numbers. By no means this is a large slowdown when you compare it from a global standpoint, but from an Indian standpoint, where economy can grow at 7.5, 8%, 6% or lower growth is actually much slower than what we require, right? So, for example, let's assume you grow at 6% and you add back 5% inflation or 4% inflation, which means that your nominal growth is going to be 10 to 11%. Now, nominal growth at 10 to 11% will be a big drag for corporate earnings. And I will explain to you in the next few slides what does it mean. Please remember this number of 10 to 11% nominal earnings growth. So not only the high frequency indicators, but we've seen that over time, the driver of India's growth is also changing. So services sector, which was a large driver for India's growth, has slowed down, right? We have also seen a slowdown in consumption, which is now showing up in numbers also. And another important factor is that uh, we used to grow on a nominal basis in mid to high double digit. Now, the biggest components or top five weights or the fastest growing components of the GDP is also now growing in low double digits, right? So you can see these numbers have changed. So the growth momentum has over the last 10, 15 years has shifted. Earlier, our nominal growth numbers and real growth numbers used to be more robust, at least for the larger components of the uh, growth picture. Now, those numbers have slowed overall, which means our growth momentum from a long-term standpoint has actually reduced. Our growth absolute numbers have actually gone down, right? This is a slide which will talk about how momentum has changed. How large cap and small caps have seen differentiation in momentum. We'll come to this slide, later on and maybe talk about these two, three numbers. But I want to go back and talk about, the nominal GDP growth numbers, and I'll go back to those two slides once again. But I want to talk about nominal GDP growth, which I mentioned just earlier. So when you think about the 10 to 11% nominal GDP growth rate, corporate earnings also will grow, at a similar pace. What is very important is that, let's say if nominal GDP is growing at, let's say, 11 or 12%, corporate earnings will tend to underperform nominal GDP growth rate. Very few people will look at the long term numbers and try to do this calculation. But think about it this way: if corporate profits starts outgrowing nominal GDP, then over time, mathematically, corporate profits in any given year can actually become bigger than nominal GDP. This is a mathematical anomaly, okay, which means that it is not possible. It is possible only in short spurts. So you can see a year or two or three where nominal GDP is lower than corporate profitability, but it is a condition which is not possible to endure. It cannot happen forever, right? Which means that mathematically, corporate profitability will always be lower than nominal GDP. So let's assume that if nominal GDP is growing at 11 or 12%, then the revenue growth for corporates will be possibly be around 11% or slightly lower. There will be some industries growing at more than nominal GDP, some industries growing at slower pace than nominal GDP, but roughly it will balance out, and you will see that corporate revenue growth or sales growth will be closer to nominal GDP, slightly lower. Now, corporate profitability or the profits or PAT, profit after tax, will be will grow at a pace which is either equal or slower than revenue growth, right? And the reason for that happening is that managerial or entrepreneurial ability varies, which means that if you take 100 companies, all 100 companies will not be the most efficient. There will be a set of companies which we call high quality businesses. They will be run more efficiently. So they might improve their margins. They might actually improve their profitability. But the power law stays here also. Maybe 18-20 rule will stay here. 80% of the companies will not be able to do it. So on an absolute basis, lesser number of companies will be able to improve their margins. And therefore, profitability will lag sales growth. And now, so if you are able to follow my line of thought, A, nominal GDP, slightly lower sales growth, and third, slightly lower profit growth. And when you talk about profit growth over the longer term, stock market returns will follow profit growth, right? So this is now the fourth level. So nominal GDP, sales growth, corporate profitability, and then stock prices tracking that corporate profitability will be slightly lower than that. That means that if, let's say, earnings are growing at 10% CAGR over a 10-year or 20-year period, stock price return will be slightly lower than that. Okay. And it will not match that number. It could be slightly lower, maybe 10, 20 basis points. And the reason is again that all managements are not similar. Um, and then comes investor returns. So let's say if stock market is returning 10%, then investor returns will be stock returns minus the tracking error, which is the brokerage fees or the management fees that you are paying in a mutual fund setup. So your returns will be lower. So now these are the degrees of separation from GDP perspective to your returns. So let's do the numbers and take a simpler example. Let's assume nominal GDP grows at 11, revenue grows at 10.5, PAT grows at 10%, stock prices give returns of 9.5, and investors make 9%. Okay, this is the natural mathematical way of how markets will give returns over a long period of time. But look at this slide. What has happened over the last 10 years? EPS has grown at 8.5%. PAT growth was higher. The EPS is because of the weightages of stock. Nominal GDP was 10.7%, so this correlation is maintained. But the stock price return is 14.3%, Nifty total return. And why is this return higher? Because investors have started to overpay for same amount of earnings. So our price to earnings multiples have jumped from about 17 times to 23 times. And this has gotten added to our returns, right? So we made this extra return. The reason is that the multiples have expanded. So you are paying a higher price for the same earnings that you are getting. Now the question for investors to ask is, A, can it continue to be at this level? So that is question number one. If it continues to be at this level, then our returns will match the returns made by corporates. That means if corporate profits are growing at 10%, our returns will also be 10%. What if this number goes down back to 17, right? Then our returns will be subtracted. That means even if earnings grow at 10%, we will not make 10% because the multiples will fall, right? And this, I think, is one of the most important and biggest risk to how I see the markets today, where they are placed, because the multiples have expanded by around 680 basis points. And if we fail to show the same amount of earnings growth, which we are showing here, 9.5% or so, these multiples will come under stress. And this, I think, is something which we need to be very careful about. And this slide is something that you should look carefully and look at this data more carefully. We'll go back to two more slides and we'll talk about India in greater detail, and then we'll talk about valuations also. So this chart will talk about where the markets are placed today. So what we were seeing is that momentum factor was helping small and mid cap stocks by a great extent. But now we have started to see that that has started to reverse. How do we see that? If you look at in the last 3 to 4 months, returns from small and mid caps have sort of plateaued. They haven't really gone down. Small cap and mid cap are still maybe close to 3 to 4% from their all-time high or 5%. So there hasn't been a significant correction as such, but the rate at which they were rising has sort of plateaued. Okay, this is the first sign of how things reverse or change over time. It is called rate of change. So first the rate of change is very high, then it plateaus and it reverses. This is exactly what we are seeing here. And we earlier also highlighted that large caps could be a better place to hide. And slowly and steadily, that appears to be the case now. We are seeing that play out in numbers. So that view continues to remain strong, that large cap would be a better bet currently, or possibly when you want to do small and mid cap, do only quality oriented factors or quality oriented funds, right? We'll come back to this slide at the end, why India outperforms, because I think it is a very, very important topic. But first, we'll talk about valuations, right? Where we are in terms of valuations for India. if you look at this slide, it talks about what we call Nifty uh, price to peak earnings ratio. Now, what is price to peak earnings ratio? So, the uh, PE ratio is nothing but price in the numerator and EPS in the denominator. So, market cap divided by profits, or the price of the stock divided by the earning per share, right? This is how you calculate the PE ratio. So, for calculating the peak earnings ratio, in the denominator, we took the peak EPS. What does it mean? So, for example, Nifty EPS, let's assume, goes from 500 to 1000, right? And then maybe it comes to 980 and then goes back to 1050, right? So, what we are going to do is we are always going to take the highest PE multiple that was available at that point in time. So, historically, whenever EPS makes a lifetime high, that becomes the value that we will take every time, right? And that is how this ratio is made. And as you can see, and how does it help? Because in a growing economy like India, we've seen over time either earnings plateau, that means their growth rate becomes zero or flat, or they rise. There are very few instances where EPS falls, like a COVID case or a 2008. EPS generally doesn't fall significantly, even if at all, and therefore taking the peak EPS makes a lot more sense. What does it tell you? It tells you where is the market in relation to the best earnings that we've seen. So when you look at that number today, our peak price to peak earnings ratio is the same as that we saw during the peak in 2007 or during the global financial crisis, right? We are sitting at that peak even after the small mini fall in prices that we've seen. You can't even call it a correction. You will see that price to peak earnings ratio is still hovering at levels which are 1.5 standard deviation away from the mean and closer to the highs that we've seen, right? So what does it mean? Either there is a big time correction in store, which means that market remains where they are and they keep on hovering in some range, or there could be a large price correction, right? So either of them is possible. We have no clue which one will happen. It depends on so many factors, so we have no idea. But these two appears to be what could unfold over a period of time. Of course, market can continue to do something extraordinary and continue to rise and show this peak earning ratio rising even further. But to bet on that will be slightly more adventurous, and I don't think that is the best policy to do given where we are in terms of valuations. Second is the valuations of small and mid cap. So in 2007, they peaked at 20 times trailing earnings in terms of median trailing 12-month price to earnings ratio. In 2017, it was 29x. You can see 1.5 times 2007, right? As you know that markets can continue to do crazy things. So they did that in 2017. And now it is more than 2x of 2007 number, right? And this is where we are. Can we go to 3x? Maybe, I don't know. But investors who are more defensive and value oriented will not bet on this going to 3x. Even if it is going to 3x, you will not be betting on it, right? You will be probably taking a more nuanced stance saying that I would want to participate closer to the averages or below average, where margin of safety is very high. Currently, the margin of safety is absent. This is what the this complexion shows. Third on earnings is the earnings expectation. So this is slightly complicated chart, but not very difficult to understand. This red line here shows you the earnings expectation through upgrades and downgrades of stocks by analysts. So when this red line is very high, that means analysts are upgrading their earning estimate. For example, if a stock earns 100 rupees and is likely to see a 10% earnings growth, analysts are saying the earnings growth could be 11 or more. That means they are upgrading their estimates repeatedly. So when this line is at the peak, which means that most analysts are upgrading their estimates at a very fast pace. You can see that we are very close to the peak in terms of, you could say, analyst positivity, where most analysts are very positive on earnings growth. And you've seen that whenever this occurs, usually the market has to climb a very high expectation hurdle. What does it mean? So, for example, there is a stock earning. A stock is reporting its earnings, and the analysts estimate that earnings will grow at 20%, right? And And then in the next quarter, the estimate is that earnings will grow at 21, 22, or 25%. There is an upgrade, right? The stock fails to meet that number. That means A, the earning expectation is already very high, 20-25%, and then the stock is not able to meet that earnings growth. What does happen? A, the stock is already overpriced because it has been delivering very strong numbers, so investors keep on buying that stock. Now, the moment it fails to deliver that earning, it gets punished significantly. And those of you who are tracking these earnings numbers, you will see that any company which is failing to beat earnings is getting punished significantly. And the reason for that is that earnings upgrades are at a level that we haven't seen for a very long time. Now the black line. As you can see that whenever this red line is very high, usually you will see that stock prices will see a muted return or a decline. And what is the reason? Because they have a very high hurdle to cross. In order to continue to rise, companies need to report extraordinary strong numbers, which usually is not possible. And this is again one more indication which tells you that you need to temper down in terms of your expectation because the market expectations are very, very high. It's going to be very difficult for stocks to beat these expectations, right? So this is something which is very critical in terms of numbers. And the last is the IPO market. This chart shows you how India is placed in terms of the overall IPO. What are the proceeds that we are getting? You can see by proceeds, which is that value. You can see in USD billion dollars, India in the first half of 2024, this is the first 6 months of 2024, India saw $4.7 billion in terms of IPO raisings, which is 9% of the globe, which is the second highest number after United States. And if you add the last few IPOs, this number will go out of whack completely. We remain number two, but we'll get closer to US. And in terms of number of IPOs, we are at 151, US is at 82, and the third number, which is other exchanges put together, and actually the third, which is China, is at 44. You can see that we've got almost one third of all IPOs globally. Uh, Not all IPOs, but in terms of overall share, we are at 27%. So at least 1 in 4 IPOs globally are happening in India. What does this mean? What does it mean? One, that easy money is available and therefore IPOs are coming. And if you sit and think about it, when will promoters sell their stocks? Okay. So there is a big disconnect between a buyer and a seller. And what is the disconnect? That the seller can choose the price and time of selling. Okay. And that is what happens in IPO. When the promoters are selling, they choose the price, they choose the time. Buyers can bid or they can take away their bids and not choose to buy. But when there is easy money environment and people are chasing these issuances, they will go and overbid these stocks, and that is what is appearing these numbers. What is the conclusion? It is a contra signal. It tells you that when primary market activity, where again the seller has an advantage because the seller is choosing the time and price of selling, you need to be very aware of how do you participate in these issuances. So our idea is to be very conservative with your estimates and also be very conservative with your money. So this was about valuations and IPO, all of them showing signs of caution. And these are not new signs. They've been available for the last 6 months. And markets can do funny things. They can do anything over short periods of time. But these clues of caution have been there for some time. Now we'll go to the last slide, which I said that it's one of the most important slide where we'll talk about why does India outperform? And usually, when you look at this question and try to address it, we hear some arguments like Indian GDP going from 3.5 trillion to 10 trillion, 20 trillion, 30 trillion, or some vague numbers of 20-year growth or 25-year growth, or India becoming the largest economy in the world, or some other story of this sort. But unfortunately, most of those ideas are not true. And if you are following our different publications from different months, you will know that we have showcased with data that how those numbers have nothing to do with how equity markets work, right? So then the question is, what matters, right? So one very important question to ask ourselves is that why do stocks make more money than bonds, right? And usually the answer is very simple, but it is not very commonly known. The simple answer is that companies or entrepreneurs or managers who are able to make a return which is higher than their weighted average cost of capital, which is, let's say, higher than the risk-free rate and cost of equity, they are likely to deliver higher returns. So the excess return that equity delivers to shareholders comes from the managerial risk taking that happens in equity. That is it. Now, when you look at this definition, it does not talk about FI flows or GDP or any other parameter, right? It only talks about that excessive return over and above cost of capital. So one way to measure that return is return on equity. So when you look at this graph on your screen, you will see that Indian markets, after United States being one of the most prosperous nation in the world, has the highest number of companies in percentage delivering a ROE of more than 20%. Now, why did we take 20%? We could have taken 15, 16, 25, 30. You can take any number, but the lower you go on ROE, the more companies will qualify over time. Logically, 20% ROE is a very stiff benchmark. It's very hard to find companies globally doing 20% ROE. In India, one third of the universe is doing it, which is a remarkable feat. And when companies deliver this kind of return to shareholders, shareholders are bound to benefit. And this is the reason why India has been able to deliver. And this is the data for the last 10 years. This is not an extrapolation. We are not saying that in the next 10 years also, this is going to be true. In fact, in 2007, this number was even higher. In fact, the ROE of the whole index was 22%, right? Right now, it's at 16% or so. So less number of companies qualify today than they would have qualified in, let's say, 2005, 6, 7, 8. But still, India has more companies which are of better quality in terms of delivering returns to shareholders. And this is the reason why India performs over the longer term. And this is possibly also the reason why you should be optimistic about Indian equities, but only when they are available to you at a price which justifies this purchase. Which means that if you overpay for any business delivering, let's say, 20% ROE, and you end up paying a, let's say, PE multiple of 50, 60 times, the ability of that business to give you high returns will be diminished. And maybe ROE is not the only factor. There are many other factors, how much cash the company is generating, how much dilution is happening. But to put it simply, when you compare ROEs and the cost of capital, India does remarkably well. And this is the only reason, one of the only reasons why India does well over a long period of time. And all other narratives and stories are maybe either a supporting factor or an immaterial factor, which can be ignored. So I think this is it. I will maybe just summarize what we learned today. One, that we are in a environment, easy money environment, which has been going on for a very long time. And we think that there are signs that it could be reversing, and you should be very careful about it. Second is that foreign flows are more important for India's macroeconomic stability. Daily buy-sell figure from FI are just stories, you can ignore them. Agents of growth, both government and private sector is deleveraging, which is causing a slowdown, which is appearing in number. Complexion of growth is also changing. And as we said, between small cap, mid cap, and large cap appears to be a more preferred place today as we stand today. Then we spoke about how India's expansion in multiple poses a risk to future returns, and this is something that you should be very careful about when you evaluate your expectations for how markets will do over time. And then we spoke about valuations on all 3 and 4 parameters. They appear to be stretched and needs either a time correction or a price correction. And then we spoke about why India does well over a period of time. And the simple reason is that more high quality companies are available in India than anywhere else in the world. So with this, I will stop here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.